Edward Brown, host of the Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Doug Hallworth. You're not going to want to miss this show. That's the Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is the 1990s. Seems like a long time ago, and actually, I guess it is. It's not ancient history, but it's what we're talking, 30 years ago, pretty much. Okay, we do have a special guest, Mick Heyman from Heyman Investment Counseling. Today's topic is going to be harmonizing finances for lasting prosperity. Mick founded Heyman Investment Counseling, introducing a stress-free method for harmonizing your finances. His philosophy centers on sound money management as the conduit to health, wealth, and wisdom. Hey, Mick, welcome to the Best of Investing.
Thank you so much, Edward, and excited to be here and chat with you.
Yeah. So,
thank you.
Well, so let's start off with share a pivotal moment from your early career that helped shape your approach to wealth management.
Sure. One of the early assignments I had, I got into business in 1980, and if we recall that was not a great time for stocks.
No.
In fact, people looked at me and said, it's almost like I was going to become a ditch digger or something. It's like, what are you doing? They're doing nothing. I think stocks were up a total of 5% for the entire decade of the 70s. And of course,
74, 75. I mean, it dropped like 50%.
It dropped. And then really, and the hot things back then were gold or silver. And of course, real estate and oil. It was really hard assets. But one of my first assignments was going back. We were getting data into this new, it was one of the first, portable computers, which probably was about as portable as a couch. I mean, it wasn't, it wasn't like today's, but we needed to get data in there to analyze, different things, Fed funds rate, whatever. And of course, there's no internet. So it was like, how are you going to get the data? Well, Mick, go to the library, start reading Barron's, and each week they print this data and write it down and then put it in the computer. Well, I couldn't do the assignment without reading the headlines. And each week it looked like the world was coming to an end.
Yeah.
It was the Great Depression. It was Pearl Harbor. It was the Korean War, of course, the Kennedy assassination, and untold millions of things in between that, the media, we talk about today, the social media and the media in general always scaring people. This is not different. But the lesson I learned from this kind of, looking at the headlines going forward was the world keeps going. The headlines move to another headline. And those things that we're angsting about today, or if you remember even last year, here the market had a great year, but during the year, there were probably 10 or 12 things that we could have been worried about, this imaginary recession or the government shutdown or the default. And these things tend to get forgotten, and then we move on to the next worries. But that was one of the most pivotal things in my life, to be able to look at the market and say, you've reduced your worry a little bit, because this too shall pass. And it will move on.
Interest rates were high, and they actually still went up a little higher in 81.
They did. And people are, of course, concerned with mortgage rates at 6 or 7 here. And back then, you were buying, it was 15%.
15,
People are still buying homes. They're still living in homes. And of course, if you said rates were going under 10%, you would have been locked up and thrown out of the business. And now,
put in a padded cell.
Exactly. And now, if you said rates are going up to 10%, well, I'm not predicting that, but of course, it's the same thing. So worries never stop, and so it made me think you got to have an investment plan for yourself that kind of is long term, so that these short-term worries don't cause you to make decisions you shouldn't make.
Gotcha. Okay. Tell you what, we're going to go to a commercial break here, and we're going to ask our trivia question. Before we do, I do want to make a mention here for iTex, which is a barter company. I've been a member for a number of years now, and the best part about it is you don't have to use cash. You do trading of services, and it's a company that people deposit basically their various services in, because I might need an electrician, but an electrician doesn't need me, but he needs an accountant, and the accountant needs what I have. And so it's kind of a nice bartering system, and it's all legal. You get the 99s. It's all above board. Check them out. iTex, ITEX. All right, we're going to go to our first trivia question here. Talk about the 1990s. And again, just to remind Mick, if you know the answer, don't say anything till we get back. Okay. Who was Russia's first elected president? So the 1990s, who was Russia's first elected president? First caller with the correct answer wins that tanning certificate. Call 888-912-1190. And by the way, that certificate is worth over $100. Also want to make a mention here for Mountain Mike's Pizza in San Rafael. The Super Bowl's coming up pretty soon here. And what better way to celebrate it than get a Mountain Mike's Pizza from San Rafael? All right, stay with us. You are listening to The Best of Investing. I'm going to ask the trivia question one more time for the tanning certificate, which is, who was Russia's first elected president? All right, don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my special guest Mick Heyman. The trivia question that we asked was, they were talking about the theme is the 1990s. Who was Russia's first elected president? And no, it wasn't Putin. You want to take a stab at it?
I'll take a guess. It just popped in my head, and I'm going to butcher it, but is it Yeltsin?
Yes, very good, Boris Yeltsin. Boy, it's funny because
it just popped in my head when you said that.
Yeah, it's funny because the audience doesn't know that when we went to commercial break, you and I were talking about this for a bit, and you said, I can kind of picture the guy. I think about it, but it doesn't come to my mind. And very good, you got it just in time too. I like that. Okay, all right. So Mick Heyman from Heyman Investment Counseling. So your background combines economics with a deep interest in psychology and philosophy. How has this unique blend influenced your investment strategies?
I think what it's done is have me more sensitive to the emotions of the market, because you can get people on here who talk about the economic trends and this and that, but it's the market tends to move on emotions and doesn't move on. Every time an economic release is out there, they're talking about something that just happened 6 months ago or 3 months ago, or it's the past quarter. They're not talking about the future quarter. The markets move on the future quarters. And so it just when times are at their worst, when you see like the consumer confidence, if you look at that chart over the last 6 or 12 months, it was at the bottom of where it's been even back in the recession days, back in 08, 09. Well, guess what? After all this fear and trembling in 2000, at the end of 2022, when the market was down close to 20%, people were scared. People were nervous. People weren't expecting anything. Well, if you understand emotions, you realize just at the bad times, things tend to move the other direction.
It used to be in the old days that the market was about 18 months ahead. So people, like you said, it's really the future, because you don't want to be left behind, so to speak.
Exactly. And then the other thing is understand our own psychology. Each of us is a different person. Each of us is willing to either make or lose a certain amount of money. And that the risky money that's in stocks or real estate or whatever it is, that money, when it goes in a surprise direction, let's say it's going down, how does that affect each person? And by understanding that, you can have strong hands. somebody has strong hands with 70% in, say, real estate or stocks. Somebody else, 40%. Well, whatever that level is, if you can find that amount, then when things do go down, people are saying, oh, now it's time to buy because you're not scared. But if you had 75% of your money in stocks and they go down 20%, and that was a shock to your system and you can't sleep at night, what are you going to do? You're going to be selling when you should be buying. And so understand the emotions of that, to me, is more important than worrying about the statistics of the economy or something.
How do you get your clients over that hump?
It's really going through what's the worst can happen kind of scenarios. And, people might say, well, I'm 40 years old and I can take this risk and I should be, 75 or 80% in stocks because I've got a 20-year horizon. And the numbers would agree with that, right? It's kind of like these football guys who are going for it on fourth down because the statistics tell you, well, they're not understanding the personal situation there. And with that person, you say, well, let's say, during the surprise, pandemic, the market was down over 30% in 3 weeks. What would you do if that happened with 80% in stocks? Their eyes open up and you say, well, that wasn't predicted. Well, the next thing won't be either. There's always, every few years, there's something that's going to knock you down and you need to have strong hands. And usually by going through that exercise, people get comfortable with, okay, this is amount I can stand to lose. I was working for an older couple one time. It was back in 1987. They were worried about a crash like the 29 crash. We went through that exercise, and ironically, we didn't sell any stocks, unfortunately, but they understood what the risk was. So 3 weeks later, when ironically the market did crash, I called them up. They weren't mad. They said, the portfolio is about what you said it would be. Let's buy some stocks.
That's amazing that they could take that attitude, because a lot of people forget that before October of 87, in July of 87, it had like a mini crash. A lot of people don't remember that one.
That's right. That's right.
But yeah, it was pretty devastating. I know people who lost their cookies when they were on the trading floor, and when they went to one guy went to the bathroom and the market dropped like 500 points. He came out and he threw up. Because he was a trader, and it's a little different, but kind of scary stuff. Tell you what, we're going to go to our second commercial break here on that happy note. Talking about 1990s trivia here. What was the first animated feature film to be nominated for a Best Picture Oscar? Call 888-912-1190 to answer that question. And I can tell you're thinking because you're looking up and to the left. That's what they say, is when you're thinking hard, you're up and to the left. The audience can't see who's listening, listening on the radio, but Mick is kind of looking up to the stars and to the left. Okay. What was the first animated feature film to be nominated for a Best Picture Oscar? Again, we're talking the 1990s. Call 888-912-1190. First caller with correct answer wins that tanning certificate. Stay with us. The Best of Investing will be right back. Don't touch that dial. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my special guest, Mick Heyman. And Mick, let's see if you know, so far you're 1 for 1. All right. In the 1990s is our trivia theme. What was the first animated feature film to be nominated for a Best Picture Oscar?
Well, I'm going to take a wild guess just because I have boys that were in the 90s watching animated films, and I think their favorite was Shrek. So anyway, that's my guess.
I don't know did Shrek come out in the 90s or 2000?
No idea.
Okay. It's funny it's not a bad guess. It's not the right answer though. Beauty and the Beast.
Okay.
Beauty and the Beast.
Interesting.
Yeah. All right. And let's see here. Let's continue on. We got some good questions for you here. So in your book, Mellow Your Money, you emphasize the importance of a balanced money mindset. Could you elaborate on how self-reflection and self-awareness contribute to financial success? And before you do that, we want to make sure the audience knows how to get a hold of you in case they have questions. So why don't you give out your information, and then we'll go back into that question about your book.
Sure. And it's mick@mellowyourmoney.com is the best email. And I would love to talk to people or communicate, and I'm happy to get any kind of emails or questions. And the website is www.mellowyourmoney.com. And
Okay,
so,
and you're located in San Diego, so you're not that far away, really.
exactly.
Yeah.
And
Okay.
I enjoy part of the fun of having the book out is doing things like this or talking to
Yeah.
people and getting to know what people are
And
interested.
now you just got Jim Harbaugh for your Chargers.
Well, it's a funny thing down here. There's half the city hates the Chargers, and half of it are still loving it. So it's
Because they
they're so
moved.
mad at the Chargers because of the move.
Gotcha. You know, it's funny up here when the Oakland Raiders became the LA Raiders, but because there's a big difference between Oakland and LA compared to San Diego and LA, like distance wise. And so, when they went down to LA, a lot of people just said, forget it. I can't stand the Raiders anymore. Then they came back to Oakland, and then some people, you kind of get back on the bandwagon, and then they go to Las Vegas. It's like, all right, we're done with them. But anyway, okay, so back to the question. So in your book, Mellow Your Money, you emphasize the importance of a balanced money mindset. Could you elaborate on how self-reflection and self-awareness contribute to financial success?
Sure, and part of it relates to what we were talking about before. Is understanding yourself is so important before you start investing, because too often you could say that your first $1,000 that you go into the market, whether it's real estate or whatever it is understanding the risk and understanding your own willingness to take risk is so important, because if you lose on that first amount of money, that could influence how you invest the rest of your life. And
Well,
so,
and and with that example, if you have $1,000 and you lose 20%, now you got 800. Now you're going to make 25% on your money, and the rest of it just to break even. So you got to catch up.
And so if you're thinking about that in those terms and what risk will do to you, that's what would cause you to make decisions that what you really want with that $1,000 is to keep putting money in. So then you're making, decisions on $500,000 or $1 million as you grow older. So if you don't want those early decisions to be heavily influenced. And, one of the first clients I had was an elderly lady. She had, and people have this same thing with real estate and in stocks, where the capital gains were so high, you couldn't do anything.
Yeah.
And so even though we were managing the money, kind of, we couldn't do much. And so at the end of the year, we'd look at who did the best, who outperformed. We had these trading accounts. We had these, accounts where doctors wanted to go in and out of the market. Well, guess who outperformed everyone? It was Eloise.
The buy and hold.
And so oftentimes, doing nothing is an active decision, but you have to be willing to look through the headlines, turn that noise off. And
now, do you like? Well, let me ask you. Do you? So, I mean, you seem to gravitate more towards the stock market. Do you go for like dividend paying stocks or more just growth, or what's your general? I know each person's going to be different depending upon their appetite, et cetera, et cetera. But because I know some people who they really focus on dividend paying stocks.
I love dividend paying stocks, but what I also like is balance in everything. And so I also love technology, and it's been such a growth area for people. And so what I've tended to do with my clients is to have some technology, because that seems to be the growth of our economy.
Well, especially this new AI, it seems to be like the latest thing.
The latest thing. I hate that when they say this is the new paradigm, this is the new thing, because you remember, I know, based on your experience, the 1990s, when there was this new paradigm that ended
called
quite
the internet.
viciously. Yes. And the internet was. It was.
Yeah. Oh, yeah.
That doesn't mean there's not a huge valley in between. And so, but I love technology for the long term, but I balance it with these kind of slow moving dividend payers, so that you kind of always have something working, or at least something protecting you from untoward markets.
Not a bad philosophy. Tell you what, we're going to go to our next commercial break. We have one more trivia question to ask here. Then when we come back, we've got some other good questions for you about long-term investing, and let's see. I got a few other questions to ask you here. Okay, so third trivia question, and again, the theme is the 1990s. Who was named the first female Secretary of State in 1997? Call 888-912-1190. First caller with the correct answer wins that tanning certificate, which again is worth over $100. Who was named the first female Secretary of State in 1997? All right, stay with us. You're listening to The Best of Investing. Edward Brown here, along with a special guest, Mick Heyman. Don't touch that dial because we are going to be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mick Heyman, my special guest. All right, a third trivia question, and the theme is the 1990s trivia theme. Who was named the first female Secretary of State in 1997? Mick, what do you think?
It wasn't Madeleine Albright, was it?
It was.
Oh.
Very good. Wow, 2 for 3. Not bad. A lot of people didn't like her decisions. They called her Madeline Halfbright, but her real name is Madeline Albright. All right. So, Mick, you were how do you? You're investment counselor. You're an RIA, stands for Registered Investment Advisor. It's funny, and I didn't ask you this before. And I've got a special reason for this. Do you have that fiduciary designation? Or that, people say I'm a fiduciary.
I think that the strict definition of a fiduciary is somebody that's holding money that's actually doing a trust or something. And so I have.
That's different. And I'll tell you why I ask, because I hear on the radio sometimes, guys touting the fact of, yes, and I'm a fiduciary, blah, blah. And, that means I have to put my client's interest in front of before my own. And I'm thinking, wait a minute. Are you telling me if you didn't have that designation, you're not going to be looking after your clients first anyway? To me, that's personally, I would never tout that. I
agree with you exactly with what your views are on that too. Yes, if you're managing someone's money, you are intuitively having a fiduciary duty to take care of them. And those are down to listening to them, following their objectives. If they say, never buy Microsoft, I hate it, you better not buy it. You better have a diversified portfolio. If you say, I love Microsoft, half the portfolio is going to be in it. That's not being fiduciary. So
no, but that's a good point. So there's a difference between being called a fiduciary and having a fiduciary duty.
Yes.
Two different things. So I appreciate that. Okay, so let's see here. I think we kind of cover one of these. Long-term investing is a cornerstone of your philosophy. How do you approach market volatility and the emotional ups and downs that come with it? Did we kind of cover that a little bit before?
Sure. And what it is, and to get a little bit into the details, it's being patient. If Apple is a great example. If you bought Apple and you were so excited after it tripled, say from 2 to 6, and you just sold the whole thing, guess what happened? You missed the next 20-year run. And so be patient. But on the other hand, don't let Apple become 50% of your portfolio. Take some profits along the way. And so be moderate, but be patient, because some of these stocks that you own, you want to own all your life. Procter and Gamble.
I do want to challenge you that on just a minute here, because it reminds me back in the 80s. Now, this was, we didn't know, nobody really knew if oil was going to go down, the way it did. I owned stock in a company called Western Company of North America. Mm-hmm. And it was a company that basically provided the drilling equipment to oil companies, et cetera. And I remember I owned the stock, and it hovered around $10 to $12 a share. But what I would do is I would sell the option for, the one that would maybe as to 15 or something like that, or maybe even 10. And I was making about 20% a year by just selling the option because it would expire and I'd keep the stock, etc. But then the stock dropped to 9. And then I'd still sell the 10s, and then it dropped to 8, and I'd still sell the 10s. And I was working with back then I didn't have my license, and I was working with a stockbroker. I mean, this guy was really good. I mean, he actually, the first time that Schwab had a contest for options trading out of, I don't know, 100,000 entries, he won it. He went like 19,000% in 3 months. It was ridiculous. This guy was just phenomenal. And I remember he was he came from Taiwan, and he would tell me, "Oh, Edward," he goes, "No, that company." He goes, "You got to sell that company." I said, "Yeah, but I'm making 20% a year. And I haven't sold the stock, and I'm making 20% a year on this." He goes, "Yeah, I think if the company goes to zero." And I go, "I can't go to zero." Well, guess what? It went to zero. So I made 20% a year for about 4 years, and then I lost it all.
No, that is a good point to bring up. I have a couple of those in my background too, but it's very easy to say, how about Woolworth, or how about Xerox, or BlackBerry? Who didn't own a BlackBerry 20 years ago, and now they're in your closet? So it doesn't mean don't pay attention, because if you have a stock that's going down, and to me, I'm not a person that puts stop losses on every stock, or else the market goes down, you're out of everything. Yeah. But I do, at some point, when a stock goes down more than the market in an extreme fashion, at some point I draw a line in the sand. And bank stocks in 2008 were a great example. I mean, the minute that AIG dropped, and I can't remember where it started, but at $70 or $80 down to 50, you'd say, it's a value. Well, at 40, at 30, at some point you say, I don't know what's going on here, but I don't understand it. When you see
what's AIG at now?
I don't know. I mean, it went all the way to 1 or less, didn't it? And
AIG did? Wow, that amazes me. I mean, I'm going to look it up while we're talking here. American International Group. It's at 68.
Interestingly, that 68, if we hit a monthly thing, that 68 is down from, it had a reverse split. So when it started dropping, it was like at 1,000. If you take into reverse split.
Actually, at October 1 of 2000, it was $1,900 a share. Yeah, and in April 1st, 2007, it was at $1,400. Then it dropped all the way to 20.
Yeah. So they make you.
Yeah, you're right. No, you're right. It hasn't recovered. Very good.
If it's at $2, no one would buy it. So they reverse split the thing, and they say, "Oh, we're at $60. That doesn't sound too bad." And it may not be. I mean, I don't know anything about it, but at some point, that was an example. You name the bank. At some point, Citigroup were going down below what would be normal. And you have to admit, I don't know what's going on. BlackBerry, I've got one, but it's moving in the wrong direction. You have to be willing to move away.
Yeah, I mean, otherwise we'd still own buggy whip companies.
Exactly.
I mean, which was part of the original.
Look at the Dow Jones Industrial Average in 1980. About a third of those stocks aren't in there anymore.
Exactly. No, things change. All right. We don't have a trivia question, but stay with us, because we've got some closing comments here on the best of investing. Again, with our special guest, Mick Heyman. And don't touch that dial. The best of investing will be right back with some closing comments. Welcome back to the best of investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Mick Heyman, who is an investment counselor. And Mick, let's leave the audience with a couple of success stories.
Sure, and it's a funny thing when you talk about success. People love to say how they made so much money for their clients, but to me, success is how happy is the client. And one of my larger clients was not very sophisticated in the market, came into a large amount of money, and just wanted to be very conservative. We almost had to talk him into having any stocks at all. We kind of settled on 50-50, and we had this discipline of every time the stock market would move to 55%, we were going to cut back to 50. forcing me to sell it when it's high. If it dropped to 45%, we'd buy, and very mechanical. And ironically, you wouldn't believe how many times his allocation hit 55% in stocks because the market was going up, sell it down to 50, and immediately the market would drop within a week or a month. It was unbelievable. And he'd call up and he'd say, "Oh, that discipline, you're a really smart guy." And I'm thinking, it's not being smart, it's being disciplined. And so often people want to take credit for predicting the market or predicting the great this or the great that. But for most of us, following a discipline is the way to success. Now, did I make him all this money, or did I, create? No, but my job is to save it, make sure it stays there. And so it's a relative value game. I'm not winning the Super Bowl, but I'm keeping that team alive, type of thing.
Yeah.
So,
it's funny. In the old days when I used to do financial consulting, I think I told the story to the audience once before. I had a brand new client, and we were diversifying, and back then we were just using mutual funds. And she was very unsophisticated, but she liked the idea of diversification in the mutual funds, et cetera. And for whatever reason, somewhere in the early 1990s, I think it was, we just happened to, she just happened to invest at the right time. And the first quarter, she was up like 20%. And she just thought I was the greatest thing since sliced bread. And,
Right.
and I told her, I said, "Tammy," I still remember her name, Tammy. I said, "Tammy, listen, I think I'm good, but I'm not that good." I said, "I promise you, this is not going to happen all the time, right?" Well, the next quarter, she was up like another 15%. And she just thought I was the greatest thing. Again, I said, "Tammy, I'm telling you, we're going to have times when it's not going to be like this." "Oh, no, Edward, you're just the greatest." Well, sure enough, like the next quarter, it went down like 10%. "Edward, what happened?"
What'd you do? Right.
What'd you do? Yeah. You know what? I sold. And so that's what, supply and demand. I sold my portfolio, and that's what caused the entire stock market to drop. Yeah, no, not exactly.
If I sold my entire portfolio, I guarantee it would go up just because of my own timing experience.
Actually, I have a friend who used to be very high up in a very well-known company that he said that one time they angst for about 3 days over whether or not to sell, like literally one stock, because they were afraid that they were going to tank the entire stock market. That's how big this company was. Yeah. And I said, "What'd you do?" And he goes, "No, we just decided it just wasn't worth selling because we were that concerned we were going to crash the market." And I go, again, I can't compete with the big boys, so I let him handle it. All right, Mick Heyman, thank you so much. Now, ready for our thoughts for the day? Here we go. Okay, so I told my doctor that I heard buzzing, but he told me not to worry. It was just a bug going around. And a man sued an airline company after it lost his luggage. Sadly, he lost his case. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions, and of course, throwing in some more puns and dad jokes. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
Thank you, Edward.